Hello, everyone. Welcome to our second podcast having to do with Chapter 13. Specifically, we're going to talk about the alternative minimum tax. This used to be um, quite a pain for tax preparers. It is literally a second tax system with its own set of rules that was designed to ensure that people in the highest with higher incomes can't get away with not paying taxes because they have so many extra deductions and credits and so forth. So now over the years, first of all, for many years they made it more and more complicated, and then over the last 15 years or 10 or 15 years, they have made it simplified, and in 2017 it simplified it quite a bit, such that it is now seldom even applied. It would only come into play in a very small number of cases. So it's gone from millions of taxpayers to just a few that are affected by this alternative minimum tax calculation. But we have to put it in here just in case you come across it. You'll recognize it and know what we're talking about. So this is all done on Form 6251. There's an example in your textbook. And you start with your regular taxable income. So you're going to basically redo your tax calculation using these AMT rules. You start with your regular taxable income. So you've already done your tax. You have to have already done your 1040, right? All the way down to taxable income. And if you remember our tax formula, regular taxable income quite towards the end. This is really towards, after you've done a lot of the work. Then you're going to take that, put it on Form 6251. You're going to add the standard deduction if you took the standard deduction, or if you itemize, you're going to add, okay, your state and local taxes, which we'll talk more about that in just a minute. Okay, then there's going to be some other adjustment items and preference items listed on the Form 6251. Some are very, very rare, really oddball types of things that have very specific situations, but we'll look at some of the most common ones in just a minute. Then you take a AMT exemption amount, and that's also shown on the Form 6251. It's much bigger than what we're used to with the standard deduction, which means that people with lower incomes have no concern at all about the AMT, because the exemption for instance, for single is 85,700. Okay, so it means nobody that even that's under that much of income is ever going to have an issue with this. Okay, once you've taken out the exemption amount, and that's different depending on your filing status, like most everything else. Okay, then you multiply by 26% if the amount you got after you subtract the exemption is 232,600 or less. If it's more, then you have two tax brackets, 26 and 28. It's actually fairly simple that way. You multiply by 28% and subtract 4,652, which is the same thing as looking at the 26% and for the two different tax brackets. It's usually easier to just do it that way, the 232. Okay. That gives you the tentative AMT. Okay. Then that tax amount you compare to your regular tax amount. So you've already done your 1040, you've already calculated your regular tax liability. If the AMT is higher than your regular tax liability, then the difference is your extra. your AMT tax. Okay? If your AMT is lower, which is would be for almost most everybody, then you just ignore it, right? It doesn't come into play. But for those with not higher incomes, you probably should go through this calculation before you determine that it doesn't apply. Okay? So, since 2017, the only itemized deduction that is different for AMT is state and local income taxes and your property taxes, which are all limited to 10,000. Remember when we covered that in chapter 5. So the most that you would be adding back, okay? See, so you start with your taxable income, you add back, because you subtracted out all of your itemized deductions from Schedule A to get your taxable income. But now you're adding back the 10,000 because that's not allowed for AMT purposes. It used to be that there were other itemized deductions that were not allowed, but now all of those are allowed the same way or not allowed the same way. So they've taken away miscellaneous deductions from regular tax, and they were already disallowed for AMT. Okay, and the same rules apply to mortgage interest as used to apply just to AMT are now applied to all taxpayers. Okay, so the only adjustment for itemized deductions is the $10,000 that we paid for state and local income taxes and property taxes, state and local taxes. Okay, so you add that back, and then you deal with other adjustments. The most common ones are having to do with depreciation if you have a business. Again, if you're in these higher tax brackets, this isn't going to apply if you don't have a business or a rental property. Okay? So, and you can see that most of these things, okay, are only for properties that you've owned for a long time. Okay? The first three. Only difference personal property after 1998, okay, instead of the double declining balance method that we use in the tables, and we didn't even focus too much on that. We just used the tables in chapter 6 to calculate depreciation. You just got to recalculate depreciation using different tables. It's going to give you lower depreciation, at least at the beginning of the asset life. Okay, there will come a time when your depreciation will be higher under AMT because than on regular, and it will go the other way. The adjustment will go the other way. Most of the time, these adjustments are going to increase our income, but in years that it makes it lower, you could have get a credit for AMT you paid in the past because you owed it. But that's a little beyond this course in terms of calculating how much that would be. Okay. Other things could happen when you have gains or losses. When you sell an asset that was depreciated differently for AMT purposes versus regular tax purposes, then you'll have a different gain for AMT or different loss for AMT than you would for regular tax. Incentive stock options is adjusted for when there's income that's added to your AMT that's counted as income when you get stock options. And incentive stock options basically mean that you get them at the current price and then you get the benefit of them going up. Okay? Those are not income for regular tax purposes, but are income, or at least a partial part of them is income for AMT purposes. So that would be added on. And that's not that uncommon that companies use, although some of the rules have changed with stock options that have nothing to do with taxes that have made them less common than they were, say, 10 or 15 years ago. Other adjustments may come from your K1, from the businesses you own, part of your partnerships or S corporations that we talked about in Chapter 8, going on Schedule E. There may also be adjustments there, and some ways that handle long-term contracts. And you can see the rest of them on 6251 in your textbook that are going to come up so seldom as this does not be useful to discuss here. So those are all adjustments. So you get down there and you have alternative minimum taxable income after you've made all your adjustments. Then you subtract the exemption. The exemption amounts are here on this slide. For 2024, they are adjusted for inflation. For many years, they were not. They were the same every year. They didn't go up with inflation, but now they have been adjusted for inflation, so automatically they adjust each year. So single 85,700, married filing jointly, 133, married filing separately, 66,650. Okay, so there's not a separate one for head of household or any other. If single head of household would be single, that sort of thing. Okay, and the exemption, this amount is reduced by 25% of the income over those very large reduction limits, those phase outs, if you will. 609 for single, 1,218,700 for married filing jointly. So if your income was higher than that after you've made the adjustments for AMT, then you don't get the full exemption. So the exemption can go away if your income is very high. Okay, but the reason why this isn't going to affect most people, even at the higher income level, is because remember the tax rates for AMT are 26 and 28%. So yes, you have some adjustments and some things some tax deductions you lose, but then you apply a much lower tax rate. The highest tax rate, okay, for individuals is 34%. So that's much higher than the 26 or 28 for the AMT. So only if you had a lot of any of these adjustments would them adding in and then applying a lower tax rate, okay, end up making, having a higher AMT. But that is the process. You compare the alternative minimum tax you calculated with your regular tax. So you cannot do the AMT until you know what your regular tax is, because you can't, you have to have no taxable income. You have to have calculated your tax to compare it to the AMT amount.